Have you ever been in this situation? You found a rental property in a great neighborhood. The numbers are looking really good. You think you could attract really good tenants, but you didn't get your financing in order. In fact, you need to close the deal within 1 week. How many of us have been actually in this situation? I could tell you really early in my real estate investing journey, I was struggling in that journey, and I totally know how you feel because I was just thought I need to go to a broker, get the best financing terms, and then need to turn that around in a few days. Turns out there are multiple ways to get financing for your rental properties that I didn't even know of. So in today's video, I'm going to talk about the 5 ways you can finance your next rental property. So if you are an aspiring investor, or you're a real estate investor, or you just trying to gauge if real estate investing is for you, then you want to check out today's video. Hello everyone, I'm a Canadian YouTuber that's been investing for more than 20 years in stocks and real estate investing. And I love sharing my lessons and key takeaways and actionable steps in bite-sized videos like the one you're watching today. So if you want to grow multiple streams of income, build your wealth, and live your ideal life, then you want to, for sure, subscribe to my channel and get the bell notification so you get the latest and greatest videos coming to you every single week. So let's get back with the video. Now, the first method is traditional bank financing, where you need a down payment like 20 or 25% down payment, and then the bank loans you the rest. Now, didn't you hear me? I just said 20 or 25% down payment. The reason why there is a range is because you could be going to a bank, or you could be going to a credit union, or it could depend on your employment situation where maybe you're an entrepreneur and they're like, ooh, you have like less than 2 years as an entrepreneur, they might want to up your down payment. So traditional bank financing is actually the hardest to qualify for. And they have different rules and they're all different. But the best thing about traditional bank financing is they offer the best interest rates. Now, to qualify for traditional bank financing, like with TD Bank or Royal Bank or Scotiabank, you need a good stable income, you need a good credit rating, you need low debt, and you need to have some patience because there's a lot of paperwork involved. So if you are in a different situation, like you're an entrepreneur, you have a small business, you have actually quite a few rental properties in your portfolio, or you have other debt, and maybe even if it's productive debt, that's going to be a little bit tricky in the traditional bank financing world. So that's why I'm saying getting the best possible interest rates is awesome, but if you don't fit in that square box, it could be the hardest to qualify for. Hey everyone, be sure to check out the link below to get your copy of Streetwise Mortgages Best to Invest 2021 market research of the top 18 investment markets across Ontario. Number 2, which is high ratio financing, where you move into the home. And by moving into the home, well, it makes that home your principal place of residence, and then maybe later you decide to convert it as a rental. And that's amazing. In fact, this is one of the smartest ways to, grow your rental property portfolio, because this is exactly what I did really early in my journey. In fact, I did this like almost 3 times now. I can't even count because it's been like long stretches. All you do is that you go buy a home, you move into it, and then you could put in as little as 5% down payment, or you could put in 10%, or you could put in 15%. But anything less than 20% down payment, you do need to get additional assurance by Genworth or CHMC or CMHC. Okay, CMHC. And then what it does is then you can go buy that home. And so it does cost a little bit more because you do have to pay upfront money for that insurance, but you get away with having to pay less of a down payment. Now, this is a great, amazing strategy. If you're a brand new investor, or you're just getting ready to start in your journey, or you're cool with just moving out all the time, because this is something I've done actually even 2 years ago, where I actually decided to leave my principal place of residence and move into another home and convert my last home into a rental. And that was like 10 years after I bought the home. So as long as you don't mind moving out every few years, this is an excellent strategy. And the strategy also, you can qualify for really good interest rates with traditional bank financing like TD Bank, Scotiabank, Royal Bank, where you get the best interest rates. And a lot of times, if you choose to go with this high ratio financing strategy, You can choose any type of home. In fact, I would really stress on picking a home that has another rental income suite, because if you live in the home and you have someone who's living in your basement, for example, well, they are paying a huge proportion of your mortgage. So you're like living for free, which would be like amazing. But the realities of this is that as long as you're cool with living with tenants, if you do decide to go through this strategy, please, before you move out of the home and decide to go buy another rental property, go move into another home, be sure to get an appraisal before you move out and convert it as a rental, so that you can declare those years that you lived in that property as your principal place of residence, so that you get tax exempt, meaning you don't pay capital gains while you're living in the home. Now, the third way is getting equity out of your home or your investment properties. Now, big caveat. You need a lot of equity available to do this. So, for example, if you bought a rental property, say at $400,000, and then it shot up to $800,000, say 5 years later, well, you have potentially up to $400,000 worth of equity in that one home. Now, the only issue with this strategy is that you need a ton of equity. So you might have already lived in your home or have your rental properties for a very, very long time. It built up that equity, then great. You can go get some equity and go buy some more investment properties. So once you build up a lot of equity in your home, you could, well, refinance the home and pull out the cash. So basically you convert it into a new mortgage, and then you get a bunch of cash coming into your pocket, and then you can go decide to buy another rental property. Or you may be able to just get a HELOC, which is a home equity line of credit, which is really like a credit card assigned to your home, except you don't actually get a physical credit card. You get a line of credit against your home that's used as collateral, and that's called a HELOC. And then you can access the cash when you decide to go buy a rental property. Now, fair warning, if every one of these strategies, I didn't say go buy that boat, go buy that car. This is all about amazing money discipline. So please, if you get access to the equity, please don't go buy that boat. This is only to go buy another productive asset like a rental property. Or if you're really bad with money and you have a huge spending problem, please just don't access the equity. Now, typically with refinancing or getting a HELOC, it's up to 80% loan to value of your home. So for example, if your home's worth $800,000 and you have zero mortgage balance, you could potentially get 80% of $800,000, which is $640K. But you need to talk to your bank or my beautiful mortgage broker, which is Streetwise Mortgages, who's been helping me scale my rental property portfolio for at least, I think now coming close to a decade. So if you need to come up with an amazing financing plan, I actually didn't think I qualified for more than 5 properties. So if that you're in that same situation, be sure to talk to Streetwise Mortgages. The link is below, and the consultation is for free. Oh, one last thing about pulling a HELOC or pulling out equity out of your home, like a cash out refinance. If you decide to use this, which I highly stress, if you decide to go buy another rental property, make sure the other rental property cash flows more than enough to pay out your interest payments or to help you offset your newer, higher mortgage payments, okay? That's like, please. Otherwise, you're just draining your money, okay? You're getting yourself over leveraged. Please, be very careful. Now, the fourth way is a vendor take-back mortgage or RSP mortgage or just private money lending, which is literally saying, hey, you're not using the bank to finance your rental property, okay? You might be in a situation where, you just short a 20% down payment for your rental property and you're like, you just need a little bit more money. Well, you could talk to someone who could give you the extra cash, or you could talk to a broker who can arrange for you to get some private money lending, because there's a pool of investors who are willing to loan out their money to you to offset your 20% down payment. Or they might have a ton of RSPs that's just sitting around. They want to collect some interest, so they're going to loan out their RSPs to you so that you get a second mortgage. Or you may have found a property where, well, someone has owned the property for like 40 years and they have no mortgage in that property. They may offer a mortgage to you, which is literally saying you pay them fixed payments over time, because you know why? They don't want to be hit with huge capital gains. This is actually something that I may strongly consider in the future when I decide to sell my rental properties. Okay, now because I don't have direct experience with RSP mortgages or private money lending or vendor take back, and those are way more complicated ways of financing, because if you combine that with, say, financing with Scotiabank and they find out that you need to get this extra alternative financing method like a vendor take-back mortgage, it could get really, really complicated, which is why I really stress if this is a way that you're thinking of, please talk to Streetwise Mortgages. You need someone who's an investor-focused real estate broker because that can get pretty crazy and hairy if you don't do it right. And one more thing. Obviously, if you go with an RSP mortgage or private money lending or even a vendor take-back mortgage, usually the interest rates are always higher than traditional financing, but there may be some situations where it may be right for you. Now, the fifth strategy is joint venture deals. Now, why would you do joint venture deals? Well, I actually, on my second rental property, I had a joint venture deal because, well, I didn't have the 20% down payment. So I decided to partner up with someone who was willing to provide a cash down payment, and I was willing to do all the work. Go find the rental property, do the renovations, find the best tenants for that property, be the property manager, oversee the property for years and years, do all the paperwork, etc., etc., etc. So that's how a joint venture deal typically works. Not all joint venture deals operate the same way. Someone could be providing part of or most of the cash down payment, and the other party could still do all the work and still have put in a down payment, a little bit. But typically it is one down payment and the other person is doing all the work. So another reason why someone might be open for a joint venture deal is if you find a very tired landlord. Okay, I was like that many years ago where I had a rental property that was a big pain in the butt, and I was just in a different time and space. I was carrying twins. I had a lot of things going. I had a really demanding career. I was traveling 50% of the time. So let's just say it was really stressful in the middle of doing many different types of renovations. So I was really strongly considering doing a joint venture deal because I just didn't want to deal with the rental property. I didn't want to hear about it. I just wanted someone to take care of it, and then I would let go a portion of the equity. So this may be another reason why a joint venture deal comes up, because you get a tired landlord that's at a different state of mind and needs to do something differently in life and wants to give up a portion of their properties so that you can take care of it. Now, another reason why you might go with joint ventures is because you flip property. So for example, you find a rental property or a property that you want to flip, but you need to close it like lickety split. Well, banks take a long time to finance the property. So you may want to get a joint venture deal where someone provides a cash down payment so you could close the deal right away. And maybe a year later, after you do the renovations, you get the property appraised, and then you may be able to get a mortgage later on. But what I'm trying to get at is a lot of joint venture deals is usually because you need quick financing, like really quick, or you just can't qualify for a traditional bank financing method, or you're just short on cash for 20% down payment. Now, the thing about joint venture deals, typically they are the most expensive type of way to finance your real estate deals because you're giving up a portion of the equity of your property to another partner. Anyways, I hope you found this video super helpful. If so, give me a thumbs up. I wish I knew all about financing my rental properties really early in my life, and that's why I'm sharing this video for you. Anyways, I'll see you in the next video.